Jeffrey Christian, we saw a spike in gold prices last Wednesday, prices we haven't seen really from April 2016, I want to say. Yet everyone was expecting this momentum to carry through, given the whole geopolitical landscape we're living in right now. But why is gold not reacting and moving higher here?
Well, the gold has moved slightly higher, and so we've tested 1360, 1370 a couple times, I guess 3 times now over the last several months. And when we saw the price spike up $22 to 1360 something yet last week, that was a sell signal to us. And it was very funny because the next morning you get this thing, gold is broken over 1350. The next stop is 1400
right.
or $2,000.
Right.
And we had told our clients to sell at that level on a short-term basis. I think that gold, investors have pulled back from gold based on international political fears and economic fears, probably at the wrong time. Most of the investors that we see who have been buying gold over the last several quarters have been buying based on short-term capital appreciation, and they're trading that range. And I think that that's one of the factors that's been keeping gold in this trading range. At some point it'll break over it, but I think it's going to take something more severe than anything that we've seen so far in terms of economic and political expectations.
What do you make of the argument that maybe it's just gold still has correcting to do?
I don't see where that comes in. I just don't. I don't understand that. That's like a catechism as opposed to an economic theory.
Okay. So you really think that it will stay in this range for?
We're looking for the next couple of quarters. We think
unless huge news breaks.
We think that what it's going to take for a move out is a much more forceful and clear downward move in the stock market, higher interest rates, and greater concerns about economic growth prospects, both in the United States and in other countries. So we're watching the housing market in the United States, Canada, Europe, and China, and we're looking at auto sales and other economic factors. We think that by the time you get into the fourth quarter or early 2019, that economic prospects may be more hostile, and you might see gold break above 1370 and make that move to 1400. But we think it's going to take a much more negative economic view on the part of the consensus investor before you really see it.
But even in the context of higher interest rates?
It's going to take higher interest rates to move gold higher. Because the first
that goes against everything we've been taught and learned here, Jeff.
The statistical correlation between changes in real interest rates and real gold prices is negative 16%. It's very low. So you find a lot of times when interest rates are rising, you'll also see gold prices rise. And that's because rising interest rates are more negative for the stock market and more negative for the housing market and more negative for overall economic conditions. So oftentimes in a late stage of an economic recovery, you'll see inflationary pressures build, interest rates will start building, and as investors see inflation rising and as they see the negative economic consequences of rising interest rates, they start buying gold.
Interesting, because gold did hit its highest level not under the context of high interest rates.
No, gold hit 850 at a time when interest rates were 21% in the United States in 1980. 21% nominal interest rates. So and about 8%, 9% nominal rates back then. So rising interest rates are not necessarily negative for gold. It flies in the face of what a lot of received wisdom is in the gold market, but it's perfectly in line with the actual statistical reality of the gold market and its relationship to interest rates.
Silver.
Silver has been suffering from a lack of investment demand. You've seen a tremendous decline in investment demand. We launch our silver yearbook next Tuesday, the 24th of April, from Shanghai and New York. Our estimate is that investment demand fell more than 50% last year, from about 103 million ounces down to about 50 million ounces on a net basis. You've seen strong solar demand, but it's not offsetting the price consequences of the lower investment demand. Again, it's going to take investors coming back to silver before you see the price rise.
What do you make of the gold-silver ratio, sitting at around above 80 right now? Some would argue the last 4 times, it happened 4 times over the last 20 years, and every time it's happened, silver's really rallied.
one
taken off.
One time, not too many years ago, in that 20-year period, gold-silver ratio got to 80 to 1, and everybody got very bullish, and then it went to 100 to 1. And then it came back to 80 to 1, and that time it was bullish, on the way back down. The gold-silver ratio is an indicator of the relative strength of investment demand in gold relative to silver. And over the last few years, you have had investors becoming more interested in gold again. Not as much as they were back in, say, 2010, 2011, but they are more interested than they were in 2014, 2015. And at the same time, you have had those same investors not getting so much involved in silver. So you've seen a much weaker investment market for silver than you have for gold, and that's why the gold-silver ratio is as high as it is. Yeah, it signifies that gold is highly valued relative to silver on a historical basis, and that is indicative that silver probably should be expected to play catch-up at some point, but that some time that could happen where you find that catch-up could be months, quarters, or years away.
Jeff Christian, always insightful. Thank you so much for joining us.
Always a pleasure to be here.
And thank you for watching. We'll have much more for you on Kitco.com.